please may I invite my fellow panelists over. So just whilst they're coming up, I'll just introduce myself. As Julia said, I'm head of private markets, so I have the privilege of making sure we can really enable that funding continuum, and I hope the discussion today with investors, a couple of founders, and including our partner Floww, will be insightful. And want to allow for time for a lot of questions from the audience as well. So maybe we can just start off with everyone introducing themselves a couple of minutes. You know, we have representatives from, we've mentioned Floww, but we've got Alun from Loop Technology, we've got Business Growth Fund BGF, Silicon Valley Bank, and also finnCap, so who are advising and working with growing companies. So maybe if I can start with you.
Yes, hi everyone. So Hannah Waters, so I'm at BGF, so a regional investor, so I'm actually based in our Cardiff office, but covering southwestern Wales. So I joined the team about 2.5 years ago, but really back in BGF support for regional expansion, so really keen to be doing more investment in Wales and see the value of having people on the ground and being able to focus on the local businesses that we're working with.
Hi, I'm Zuleika, co-head of Private Growth Capital at finnCap. I work with early stage companies to access capital in the UK.
Hi, I'm Sonya Iovieno from Silicon Valley Bank. So for those of you who may not have heard of us, we are a commercial bank that focuses exclusively on working with high growth technology, innovation companies and the private equity and venture capital funds who invest in those companies. And so with SVB, we work with early stage companies right from seed through to IPO and beyond.
I'm Martijn Wever. I am the founder and CEO of Floww, which is the fintech play that we entered into a partnership with the London Stock Exchange Group. I also am the founder of VC firm Force Over Mass Capital, so I can give you a perspective on both as an investor as well as an entrepreneur.
Hi everybody, I'm Alun Reece. I'm the managing director and founder of Loop Technology. Loop are an industrial automation company. We were started around about 24 years ago, and we've had quite a journey in that time, and hopefully I'll get a chance to share some details of that journey with you in a little while.
Great. Thank you, Alun. Maybe we'll start with you, given that you're one of the companies that's been supported by Innovate. Could you, over that 24 years, if you could share what that funding journey has been like and how you've sought to bring in external finance into the business, or not?
It's been an interesting one. I mean, there's lots of stages to the growth of a business, and some people grow their business by investing or reinvesting from their balance sheet or working capital. Other companies go nearly straight into sort of some form of external investment. We're in the sort of first category, so we've grown our business predominantly organically. So I say that, but it's not without some form of external investment, but primarily our investment has very kindly come from both Innovate UK and the Aerospace Technology Institute. Without them, we wouldn't be where we are today. So we started small, it was just me. And we're now at a point where we make very large machines for putting composite fabric into molds at very high rate. Sounds a bit dull, but it's really tricky. And it's quite complicated. It's like draping a huge curtain into a 60-foot long mold that you have to place it with around about a 2mm accuracy over its entire area. So it's quite challenging. But by having that investment from Innovate UK and ATI, we've done the hard yards effectively since 2010. It was our first involvement. Back then, I think it was called Technology Strategy Board. But we spent a decade or more investing in R&D, and we keep investing in R&D. And that's where we're kind of focused. We've got machines out there now, like I say, making 60-foot long wing skins. So it's been a journey from me writing software to a whole team of people delivering these kind of systems. We are currently now trying to exploit this technology. The market is preparing to accelerate. The whole lightweighting arena in aerospace is a big topic, as it is in several other industries. It's a massive opportunity. It's a global industry, and we're probably not going to be able to grow to that full potential just by reinvesting from our balance sheet or working capital. So we've had some great help from our Scaleup director, Scaleup directors. They've been phenomenal. I say I'm not really a businessman, I'm an engineer at heart, and this is all alchemy to me. The whole finance arena is still a big area of unknown. I feel very much like an apprentice, but the guidance that the team at Scaleup have provided has been first class. So we're on a journey. We're trying to get investors. We haven't got there yet. We're in quite advanced talks with one investor, but I suppose for us the experience has been quite bumpy, that because the real inflection point for us in terms of massive growth is a little way out yet. It's probably the end of this decade. I think that's too long term for a lot of people, a lot of investors. And because it is quite technical, the potential for the business, it might be the way I speak and the way I communicate, but it's difficult to impart that potential into a potential investor. They don't quite get the nuances, but if I were to say there's opportunities in the next 10 years for over £500 million worth of business for our company. I'm an eternal pessimist. We probably won't get that. Be nice if we did. Be a nice problem. But the market there is enormous. But for us, convincing investors is a tricky one. But being here today, I hope to learn exactly how to do it. And then, we can grow.
I'm sure we will collectively be able to help. So, Zuleika, maybe I turn to you as an advisor to growing businesses and of different stages of growth as well. What would you say to Alun and his kind of journey in thinking about external investment?
Yeah, absolutely. I suppose my first suggestion would be map out your whole funding journey. It sounds like it's not one step to the end. There'll be several stages. Make sure that you have a plan, and then really do your research and speak to lots of people about what types of investors would be open and interested in your type of business. And then maybe speak with those investors at an early stage, or try and understand what types of metrics they might be tracking or what aspects of the business they might be interested in, so you can start tracking those metrics and start building your story, so that when you're ready to pitch to them in their IC, that you have all the answers to the questions they might answer and put it in the right place.
And so you guys are interacting with different types of investors. What kind of trends are you seeing from the investment community right now?
Yeah, I mean, I'll be honest, it's not the best market to be raising money at the moment for various reasons, but there is a lot of cash out there in the UK waiting to be deployed. I think investors really are, across the board, looking for robust business plans, strong management teams, and people that are well positioned to ride the company out through the potentially challenging next few months or years.
Sonya, if I turn to you as well, we've seen different instruments emerge over time, over the last 10 years in the UK and actually globally as well, and venture debt is one such area. Maybe you can tell us a little bit about what's happening in the venture debt industry right now in the UK, how it complements other forms of finance that some of the companies may be looking at.
Yeah, certainly, and it can be a little bit confusing, because if you go to the US, where venture debt is very well established, and you use the term, it means one thing. All lenders who lend venture debt lend in one way. The structure is exactly the same. If you speak to 5 different lenders in the UK, they'll probably give you 5 different types of facilities and call it venture debt. So they're referring not to a facility, but the life stage maybe of the company. I think certainly when Silicon Valley Bank lends venture debt, it has a very specific purpose. it's not going in supplementing, or it's not instead of equity, it goes in alongside equity. So if you're raising an equity round of, let's say, 4 or 5 million, and it gives you maybe 18 months of cash runway, the role of venture debt is to extend that runway, so you have a little bit more time to grow the value of the company, extend the metrics, and also maybe as an insurance policy. So while entrepreneurs, Alun accepted, maybe are an incredibly optimistic bunch, you know, you have to obviously build in contingencies in your business, and if you hit a bump on the road and for some reason it takes you maybe 3 or 4 months to get to the stage where you're ready for your next equity round, then it's great to have the venture debt sitting there as a non-dilutive instrument that you can use to sort of bridge that gap. I think generally when you're thinking about putting debt alongside equity, you have to think about the type of company and the journey that you're on as well. There's always a sources and uses case, and you never really want to over leverage a company. Most companies who are taking venture debt are loss-making companies. They're cash burning. They're not really intending to repay the debt from cash flow. And most venture debt facilities get repaid within about 18 to 24 months because these high growth companies are typically raising more equity again, and the venture debt will continue to complement. I think the point is very true. This is a really challenging environment at the moment. And so certainly one of the pieces of advice when it comes to taking debt as much as equity that I would share is, please try to speak to potential investors long before you need to raise the equity, for all the reasons that you listed. And it's exactly the same as with debt. Have the conversations early, get the lender, familiar with your business, so that they will understand how to structure it for you. And then when you're ready to obviously blow the whistle in terms of starting your funding journey, hopefully you have the key players lined up. And a few of them. It's good to create some competitive tension as well.
Great, thank you. Hannah, if I turn to you, we have businesses from across the country, and you're based in Wales. So, what trends are you guys seeing at BGF in terms of investment going into the regions? How do you approach that? Obviously, regional teams is one element. But speaking to some of the companies over lunch as well, hearing about what some of the challenges they're facing, trying to attract investment and actually also commercial opportunity. They feel like they need to have a London base to be able to do that.
Yeah, there's definitely been a growth in the regional activity. And I think success breeds success there. So actually, the more activity that happens, the more it attracts additional investors, the more angel investors are then created off the back of that. So I think the more activity we can do regionally will massively impact, the landscape going forward as well. More and more investors are having a regional presence. So BGF has 16 offices across the UK and Ireland. We invest over 70% of our funds outside of London and the South East, which we're really proud to do. But actually, a number of other investors are now seeing the value of having people on the ground locally. So like LDC have obviously got a regional model, as well as, I know Mercy have just opened an office in Bristol, and I think they see that they need to be closer to the businesses. I think COVID has kind of evolved that. Now that we're back into a bit more of a hybrid world where, you don't have to be based in the regions to put investment into local businesses. So speaking to some of my colleagues across the UK, so I know Scotland are seeing a lot more competition from funds outside of the region. That might be other regional funds, as well as London funds, as well as overseas funds. But actually, in other regions, we opened an office in Northern Ireland last year, and actually have seen a lot more traction since having an office on the ground and people in the local market. And there's less competition from outside of the market, just there's a different kind of funding culture in that space. But yeah, I definitely think it's ever evolving, and as I said, the more activity that we can help drive that growth will then increase the number of angel investors, funds that have the appetite to invest. But there is challenges around valuation, and like I said, overseas investment. We touched on the US, and seeing UK assets, and there are many amazing UK assets that they want to get invested in, and actually the valuations being softer than they are over in the US. Sees that they can pick them up at a good valuation, but pushes UK private equity beyond the realms of, or pushes their valuations up as well.
And do you think companies themselves could be doing something more to network into those investor communities?
Yeah, I think as the ladies have touched on, I think having that network is massive, and I think early conversations really is key. We often speak to businesses for 4, 5, 6 longer years ahead of investment, and that might be because they're not sure yet whether they want to take on equity or not. It might be that they're not in a position to do that. But I think you're right. I think helping get feedback from investors along that journey really helps shape what the business needs to look like to raise the type of investment that you want. So yeah, I never underestimate the power of the network. I know someone touched on it earlier, but actually, yeah, trying to branch that out and speak to others that have gone through investment rounds that you know locally, speak to peers that are currently going through the rounds, speak to local advisors that really understand that landscape. And I think, you know, new technologies, the likes of Floww, really help kind of try to bring all that information and investment landscape together into different platforms, because I think there's a lot of information out there and it's probably sometimes quite difficult to see who might be the right fit in terms of your sector specialism and the types of funding that you're looking to raise.
Yeah, great. Yeah, we always talk about make sure you're doing due diligence on your investors just as they're doing DD on you. Really important. So Martijn, turning to you, tell us a little bit about you. Obviously, you have your own VC fund. Yeah. You've started your own business. You're an angel investor, so you've got different perspectives. Tell us how you're seeing the landscape, and then what is Flow's mission?
Yeah, it's quite interesting. As a VC, obviously, you have your small ecosystem, and you see your deals actually coming through. You're trying to gauge actually about the companies, try to get an understanding, and actually try to get to know people like you. I really, will be interested to learn more about it from that perspective. So there's a hell of a lot of data that you need to consume actually to get a picture of what companies are actually doing, and that's quite challenging. So that limits the sheer volume what a VC or a fund or any other investor can actually cope with. And that's a shame. So what you will see that these networks actually will start using referral systems actually to get as a first line of defense to slow down the sheer pipe actually of deals that they can assess. And that's the reason why I wanted to create Floww, is actually to solve that problem and to give everybody a fair chance of actually being in front of that VC without having to know that particular person and that relationship. And so at the foundation is exactly all these things that we are mentioning over here, is that when you make an investment, you need some form of comfortability around the company. That means some data, and I think that the trend will actually extend quite a bit more going into these challenging times. And that's fine. I think when you get an investor on board, it is all about opening up a little bit. It is a trust relationship. You want to show a little bit about the company, what it is that you're doing. And at Floww, we help with that. We basically help the companies put their best foot forward before they engage. We have real accountants actually helping them out, creating a beautiful profile. They can continue to report also post-investment. So that kind of helps with that relationship where also the founders and the companies actually are in full control. What do you share with whom at any point in time? So trust goes both ways. And that's how you meet each other actually in the middle when you actually make an investment. Yeah.
Great. I'm happy to take questions from the audience, or I'm happy to continue interrogating, but yes, please.
I'm Fiona Hudson-Kelly. I sold my business last year, and I've allocated some of those proceeds to reinvest into UK entrepreneurs as an angel investor. But I really struggle with valuations. So many times I see a relatively young business, less than 3 years, still in the startup phase, pre-revenue, no IP, nothing really to clearly differentiate themselves in the marketplace. Valuations of 4 million. And it's time consuming doing the due diligence, but it's quite soul destroying as well. Is this something that is quite common?
Yes, it is something that happens a lot, and I think because we're actually operating in a very intransparent landscape, so even the VCs, they also don't see what other people are seeing, so people are quite constricted actually to the amount of deals that they've seen in their own realm, if that makes any sense. So therefore, there is no benchmark where people struggle actually what is the real valuation. Even founders don't really know that. There's obviously these amazing war stories that people read in the press, and that sometimes gives them the wrong idea what the true value of their company is. So you see some inflated valuations. I think the current market circumstances will actually put an end to that because I think it will be a lot tougher actually for people to get these investments off the ground. And I think that's a good thing, because I think overinflated valuations only sets people up for the wrong kind of expectations, because in the end of the day, you still need to reach certain milestones at T plus once the money is finished. And that's a misunderstanding I see a lot with very young entrepreneurs or people that haven't, this is their first company, for instance, or the company's just started, so they were very much in that dream state where they think, yeah, but this is amazing, the business model is fantastic, and if you compare it to this, then it should have that type of valuation. So, yeah, do your own due diligence, look at the data. Does it make sense? There are some factors where you have a big swing on the upside. That's obviously team constitution, defensibility. These things are difficult to measure and see in a business model or something like that. So you have to take that into account. But if I look at this particular idea, without knowing that company, no defensibility, that's not good. You need massive defensibility to pull something off. Multiples, look at certain multiples, etc. If that doesn't work, and realism. An entrepreneur needs to be realistic about the true value of their business, and you can debate it. And if your gut says no, then step away, or at least start to engage. That's what I would do.
Yeah, and I think.
Sorry, I just want to finish by saying. Can you hear me? Thank you for that. I just want to finish by saying I'm really interested in the Floww ecosystem that you're describing, and I know Innovate were talking about that as well, because I think if we can try and homogenise some of the data points that are uploaded into the platform, it makes an investor's life a lot easier to be able to measure like for like. One of the things I really want to see is somebody that's actually not just going to spend other people's money, but have got some skin in the game themselves and have some at stake.
Thank you. I think it will make the market a lot more honest as well. Like we at Floww, we don't judge, we just facilitate. So we allow and we facilitate, but we're not a centralized kind of database or anything like that. I wasn't right in The Economist, but we're a lot more than that. But we facilitate people to actually being able to make a judgment call. And I think for those actually that raise capital through it, and they will become more consistent in reporting, they will become better entrepreneurs in the long run, and especially in these times where valuations are being challenged in the public markets, and that will definitely, and has already started to filter through in the private markets that usually have a delay of around 6 months. So yeah, and thank you. Happy to show the platform.
Yeah, no, on valuations from a company's perspective, the companies in the room, you should think about. We talk about thinking about whether it's public markets or private markets. Your valuation at a particular point is important, or at a particular fundraise, or when going to the public markets is important, but think about how the investors are going to support you for the longer term as well, so that over time your value is continuing to increase rather than for that single kind of valuation point. Other questions?
Hi, I'm Jurga Zielinskaya from Guild Talk. Good to see you in person, Zuleika. So, question I have actually in terms of the going back to the evaluation of the business. So there's one evaluation for the United Kingdom, or call it Europe, and there's another evaluation for the United States. And actually, Guild Talk, my company, is going through fundraising. We're part of Innovate UK network, and it's been quite a journey. So the question is, why such a big difference? Because people are talking it's a double. So if you go to the United States, you get double versus the United Kingdom investment. So question one. And then question two, following on to the actual how long does it take to raise money? Yes, you could start the conversations, but the markets are moving so fast. 4 or 5 years is a very long time to have a conversation. The question would be, what is a typical expectation in terms of, if there is such a thing as typical, in terms of fundraising, how long, in your view, it should take? And if it takes very long, why is that?
I think in terms of the valuation point, I think the maturity of the US, and like I said, I think the valuations that keep getting pushed up there, and I think that's a difficulty actually, like you said, coming back to earlier stage valuations, when people are trying to value their business in the UK, they look to the US and say, well, actually this business is raising money at this valuation. It's really difficult to try and be comparable. But yeah, they're being very competitive, seeing that they can pick up UK assets at much cheaper valuations than they can over in the US, which is allowing them to pay higher multiples than a UK private equity might. So that's really kind of pushing that on the upper end. And then I'll touch on timescales and you can cover off as well. But I mean, from BGS perspective, we can complete an investment within 3 months if we've got the data available. I know I spoke about the longer relationship, but that might be that, we're speaking to them when they are at angel phase for, a larger kind of institutional round later. But we don't need to know business for that long. But so typically we can do it within 3 months, but we're a minority investor, so we come in with a really efficient diligence regime, whereas others, might be more intense, and it could be, kind of pushing 6 to 12 months for a typical cycle.
Yeah, I guess it depends on the investor type and their own decision-making process. If it's taking really that long, they're probably not the right party, right?
But there can be uncertainty, and that really does push it out. And we've often seen that where they've kind of held their position to try and see what's happening in the market.
Yeah, I mean, hi, Yoga. I think as Hannah said, a typical process with a VC is 12 weeks, and that's if you're fully prepared when you come to them, and you have all the information, the business plan is in great shape, and you're ready to go through the process. We typically take a company on the road to meet investors 4 weeks ahead of receiving term sheets from when you start that 12 weeks. So that's 16 weeks. But before that, for any one company, you need to prepare. And as an advisor, sometimes we meet a company and it's 1 week until we're ready to go on the road. And sometimes it's 3 months. But it's so important that you take that time to fully prepare and have your business plan where it needs to be and the story refined, so that when you get to the process, you don't have this long drawn out process where you end up getting a bit of deal fatigue and it never really gets anywhere.
I might disagree slightly in that I think that, just to be controversial, I think the landscape actually changed markedly over COVID, and it brought US investors into the UK and into the European ecosystem in a volume and a cadence that we'd never seen before, and the result was that valuations between the US and the UK Europe started to narrow markedly, and I think that we're seeing a little bit of a divergence again because we're now going into a downturn, and that happened first in the US, and there's an experience that there's a bit of a lag here by a few months, and the experience is going to be slightly different. Part of that is the maturity piece that you were talking to. So when you're talking about the maturity of the US market, what that looks like on the ground is that even if it's a first-time founder, they are probably able to hire people who have been through startups and scale-ups several times. So you have that knowledge built into the business, which gives investors a little bit more confidence. Whereas if the entire team is first time, they've never scaled anything in their lives, then that's going to be priced in terms of your ability to execute, regardless of what the actual IP value is. But I think we've come a long way in the UK and in Europe just in the last 5 years. And we've understood also how to pitch to US investors. So we used to be a little bit coy about what the outlook for our business was, whereas I think we understand that we need to be talking about, in a very optimistic way about what the scalability of the company is, and then picking, as you say, the right investors to target. So there is still a little bit of a disconnect between US and European valuations. The only other thing I would say is the most successful founders I've seen who have kind of really done well in terms of both European and US fundraising have always been prepared. They have a data room that is constantly open and available, so that if they're having those conversations, that they can actually, rather than stand up a whole team to start a whole process, they're ready at any stage to say, let's have a conversation, and I might take the investment at that stage, so that you also then don't have to take your team away from the business to start a whole fundraising process, because you're always ready.
And we'll talk about probably in the next session on IPOs as well about US and UK valuations. Another question at the end, yeah.
Thank you very much. Darren Jones from Solihull. We abate more carbon than every business in this room, and one of the greats in the country. And as your Innovate mentor will tell you, you always take the opportunity to promote yourself. I was going to ask about America, because I've spoken to 2 CEOs that actually run household name tech companies in the last 3 weeks, and asked them, what's the best advice you can give me? And they said, move to America, which was interesting. But what I really want to understand is, how rapidly has finance in the UK understood that right now there is a different cadence in ordering of product. And so working capital needs have massively increased as we moved from, somebody used the great term earlier to me, moved from being just in time to just in case ordering. And there's a massive creaking in the economy, and lots of businesses I'm talking to, including my own, where we're having to order masses of stock now, just in case. And it's completely changing our 18-month runway. Has private equity, has finance understood this and got a grip on that? Because we're going to have some problems otherwise.
Yeah, I mean, yeah, lots of our portfolio company are in a similar position. I suppose the benefit of having BGF on board as a partner allows them to ride that wave, so they can be overstocked than they would typically be, to allow them to come out, well, hopefully the other side stronger. So we've got a number of e-commerce businesses, one business we backed last year called characters.com, so licensed children's clothing, that hold in way more stock than planned. But actually, they're hearing from their suppliers that others aren't making stock purchases. So the likes of George and Primark aren't making the big stock purchases they would have been doing 12 months ago, which stands them in a very good stead for Q4 this year because they'll have the stock to sell. The difficulty is funding it. You know, like I said, luckily they've got us on board to be able to help ride through that. But yeah, there's definitely challenges and cash constraints that are causing as a fact of holding more stock than planned.
Can I ask you a question on that? Is your bank helping you?
No. Let's be honest, British high street banks have a reputation and they deserve it.
Well, as just going back to e-commerce, you know, the business that we're involved with are unlikely to get bank funding where the banks are more nervous, especially around consumer spending and retail, to be able to fund additional stock. So the fact, you know, equity is maybe the need that they, you know, the support they need to help them get through that phase. Because, yeah, agreed, it's difficult for the banks to potentially support with that stock increase.
I think it's as much also as well the comment we had earlier about finding the right investor, finding the right lender. So it may be that, you know, a normal high street lender or retail bank might struggle with some of the working capital type nuances, but there are specialist lenders out there. There are those that specialise in accounts receivable lending, for instance. And indeed in inventory lending and stock lending. And I think it's about, you know, explaining your business to them. They certainly understand the environment at the moment and some of the constraints. Now, I tend to work with VC-backed companies, and I have seen them do additional internal rounds and taking on convertible loan notes in order to do a little bit of that bridging of the gap to give them some space to reorganise themselves.
Hi there, Alex Ferguson from FAC Technology and actually also Imperial College. I had a question. Are you seeing a trend towards investment in private companies which you might consider, say, defensive? So say Alun, actually myself, we essentially provide IP to big companies like Airbus. Does that kind of more stable business, customer make us essentially now more appealing than potentially, I don't know, a tech company doing a software platform? Or is that attitude still pretty much the same?
Shall I give it a go?
Give it a go.
I think over the last month, there's, the economy has woken up a little bit about the inflationary environment that we are facing. So therefore, people are preparing themselves actually for potential downturn. So naturally, you will have a tendency for investors to become more conservative. And that also is echoed now in the VC space where people would like more comfortability. Is that the right strategy? Probably for 80% of the investments. I would say getting more comfortability around your investment, being a little bit more conservative is the right way to do that. And then cash flow generative type of businesses where it is easier to predict the outcome are naturally more conservative as a play. However, if you look back in time and if you look at previous recessions and previous crisis moments, in these moments you actually have really large unicorn type of plays being played out that can actually profit from it. So I think you will see a natural shift in VC towards a larger part of the portfolio being invested in quite an easy to predict type of investment, where there's clear cash flow generation, clear understanding of prognosis of future revenues and etc. But still, I would always recommend then to take an outlier approach to the other portion, simply to make back the portfolio. Like VC also works as a model that you need to get the outlier to work, because otherwise the model doesn't work. So it is not naturally a business that works well betting safe. The model from an arithmetic standpoint only works well when you have outsized returns, where you have tail returns, as you call that. So this is not an easy environment for VCs to operate in going forward, but they're just at that initial point of realization of that, small adjustments, playing it safe, wait and see stand, so you'll see money sitting a little bit more on the sidelines, but there is enough dry powder actually to go into brilliant ideas and things that can give you that pop and outside return of your portfolio. Bit of a mixed bag. I hope it answers your question a little bit.
I think we had a question there.
Thanks. My name is Mark Hewitt, CEO of ISACs. We develop heat pump technologies. I just really wanted to follow on from the previous question, because you've all been sort of slightly darkly hinting about the headwinds coming across the Atlantic. And given the amount of time that is required to have a successful investment communication from both sides, it would be good to hear more precisely what you think the timescale of this upcoming period is, and would you advise companies to perhaps pause their investment activities because of the likelihood of them being less efficient?
In uni I did economics, and I have learnt that there is no such thing as a crystal ball, so no idea in terms of how long it's going to last. But I guess the consensus view with macroeconomists is that it's not a blip and it's not going to be a couple of months. Whether that means it's 6 months or longer, we don't know. But I think we know enough that if you're running a company, the people who win and come out of any recession are those who accept the reality that there are headwinds. We don't know where they're going to go or how deep they're going to be or how long they're going to last. But the sensible thing to do is to look at where you can pull some levers in your business, and make sure that you are, not sort of avoiding the issue until it's too late to do something. So, for instance, if you have investors and you can tap some more capital over the course of the next few months, or if you have a bank that you're in discussions with, that you can, right size your business. So, I think it's a little bit of looking at how you can plan around your business, and bring real financial rigor, to make sure that you understand all the cash flows in your business, you understand where you're spending money, you understand what your supply arrangements are, and where you can maybe renegotiate things there. It is an opportunity for companies to build some efficiencies in. And, when you're running lean, then you're in a good position when the economy picks up again to really be able to take off. And a company that sort of takes that action, and a management team that recognises the environment that it's in and takes action, is one that will attract investors, rather than, as I said, if you're sort of hoping for the best and don't make any changes at this time. That all sounded really dark and gloomy, but I have to say, maybe it's because sort of working with tech companies and innovation companies, I completely agree that downturns and recessions are incredible opportunities, particularly for small young companies, because you can pivot, you can move quickly, you can be creative and innovate. For larger companies, it's much more difficult to turn the juggernaut around. Really, they sort of, they're sort of letting staff go and so on, but changing their business model is incredibly difficult. So it is also an opportunity to say, right, how can I win in this environment, and then change quickly and make that happen.
Especially on talent side, I think the labour market is quite tight, and I think you see it in the big tech companies are already either letting some people go or they're on hold. And I think that's a natural thing. That's a good thing for the market. So valuations were stretched. It's a bit of a normalization between, the private assets were pumped up by monetary policy. So you get a bit of normalization. People like bashing very much, and I guess it happens a lot in this country, and bashing the tech space and innovation, and that everybody is too expensive and it's crazy. It's just normalization. It's just getting to a more fair equilibrium and not have certain cases where companies are valued at excessive levels that cannot be justified. So, I for now, it's actually, it's a sharp move in the public markets, but it's a necessary move, and now it's wait and see what happens here. Whether it is actually a gradual kind of stabilization, or whether there's some more shocks happening. So, but always be prepared for plan A, B, C, D, E. That's what exactly makes a good entrepreneur, and that's why I agree with that. The statements is you should always have your data room ready, know exactly your numbers, have run multiple scenarios on it, and know what to do if you need to intervene with your business strategy. So that's what I do, at least.
Great. I'm really sorry, ladies and gents, we're out of time. But we're going to be, all of us are around, so if you want to come and have a conversation with one of us or all of us, please do so. Thank you so much. And thank you to the panelists.